If you've ever heard people say, put some money into bonds, but have absolutely no idea what they meant, you're not alone. Bonds are one of the oldest and most widely used investments in the world. Governments, companies, pension funds, and millions of ordinary investors use them every day. But what exactly is a bond? Is it safer than shares? How do bonds actually make money? And why do their prices sometimes go down? In this beginner's guide, we'll explain bonds in plain English, show you how they work, discuss the risks, and help you decide whether they belong in your investment portfolio. So let's start with, what is a bond? Think of a bond as an IOU. Instead of borrowing money from a bank, a government or company borrows money from investors. For example, imagine a government needs $1 billion to build roads, schools, or hospitals. Rather than borrowing all the money from one bank, it issues thousands of bonds. Investors buy those bonds. The government promises to pay regular interest and return the original investment on an agreed future date. That's what a bond really is, a loan made by investors. Now, many different organizations issue bonds. Governments issue government bonds. Companies issue corporate bonds to raise money for expansion. Local councils and municipalities issue bonds to fund schools, roads, and public infrastructure. Although they all work similarly, the level of risk can vary significantly. Generally speaking, governments with strong economies are considered lower risk than smaller companies with uncertain finance. Now, there are two main ways investors make money from bonds. The first is through regular interest payments, known as coupon payments. For example, imagine you buy a bond worth £1,000 that pays 5% interest per year. Each year you will receive £50 in interest. After 10 years, when the bond matures, you'll receive your original £1,000 back. Some investors buy bonds purely for this predictable income. Although many people think bonds never lose value, that's not strictly true. Bond prices move every day. Let's look at an example. Say you're looking to invest in a bond. You see one that's paying a 10% coupon, i.e. £10 each year on a £100 bond. Current market interest rates are 5%, so you think that this is a good idea. However, the market price of the bond is £200. The market has increased the price of the bond so that the £10 coupon is 5% of the market price. If the bond was priced at 100, you'd be getting a 10% interest. Everyone will want to buy that. Because there is more demand and the number of available bonds is the same, the price will rise. In fact, it will keep rising until the £10 coupon is giving a market rate of interest, in this case, 5%. Similarly, if interest rates fall, older bonds paying higher interest rates become more valuable. Their prices will rise. If interest rates rise, existing bonds with lower interest payments become less attractive, and their market price will fall. Understanding this relationship between price and interest is one of the most important lessons for bond investors. Not only do bond prices move based on actual changes in interest rate, they also move based on perceived and expected interest rate changes. Now, not all bonds are created equal, and the risk of the issuer defaulting is also a factor in their price. Government bonds are generally considered safer because governments can usually raise taxes or issue new debt to meet their obligations. Although they're not completely risk-free, choose your government carefully. Corporate bonds usually offer higher interest rates. That's because investors are taking additional risk. If a company experiences financial difficulties, there's a greater chance it could miss interest payments or even default. Higher returns usually come with higher risks. Again, let's use an example to illustrate the point. Let's say US government bonds are paying 5% interest. That is the amount of the coupon per year divided by the current market price of the bond. Would you accept the same interest paid by a small company in a town like, for example, Vladivostok, where the chance of you getting any of your money back is a lot less? I would expect not. You might want interest of 20% or more to take that risk. So, as we have seen, not all bonds are considered equally safe. Credit rating agencies such as Moody's, Standard & Poor's, and Fitch analyze the financial strength of bond issuers and assign a credit rating ranging from AAA, AAA at the highest to C or D, depending on the agency, at the lowest. Highly rated bonds are considered more likely to repay investors. Lower rated bonds pay higher interest because investors require extra compensation for taking that additional risk. You'll often hear terms like investment grade and high yield bonds. High yield sounds attractive, but it does also mean higher risk. So, should investors buy individual bonds? For most beginners, buying individual bonds isn't usually the easiest option. Many investors instead choose bond exchange traded funds, ETFs, or bond mutual funds. These funds own hundreds or even thousands of different bonds. That provides instant diversification while making investment much simpler. Just as stock ETFs spread your money across many companies, bond ETFs spread your money across many borrowers. Bonds often help reduce the overall ups and downs of an investment portfolio. Younger investors with many years before retirement often hold more shares because they have time to recover from market declines. Investors approaching retirement may gradually increase their bond allocation to help reduce volatility and provide more stable income. There's no perfect allocation for everyone. It depends on your goals, time horizon, and comfort with risk. Now, here are some common beginner mistakes. Many beginners assume bonds are completely risk-free. They aren't. Others buy bonds without understanding interest rate risk. Some chase the highest yields without considering why those yields are so high. And many investors ignore diversification altogether. Understanding these risks before investing can help you make much better decisions. Let's quickly recap. A bond is simply a loan made by investors. Bonds usually pay regular interest, the coupon. They can rise and fall in value. Prices are driven mainly by interest rates and changes in credit rating. Government bonds are generally lower risk than corporate bonds. Bond ETFs make diversification simple for beginners. Most importantly, bonds and shares often work best together, part as part of a balanced, long-term investment strategy. Thank you for watching. I look forward to reading your comments below and seeing you on future Valkyrie investment videos. If you found this video helpful, please click subscribe. It really helps the channel grow and allows me to continue producing educational content to help you in your investment journey. Thank you, and until the next time.